That's cool.
You gotta get it. So that's kind of funny.
So
So that's probably why she didn't want to come to the meeting, because she was just starting running. She was gonna be running yesterday or this morning at 8:30 or so.
I really like the place. Did you? Yeah.
Who's that guy?
that's Alton. Why is it showing like that? We're gonna go to slide 1.
What's that? I drive past.
Yeah, it's to change the slide.
It's just like with the stick for people.
Yeah, yeah. and
Is
then-
it just a USB?
Yeah.
Or
Plug it
is
in right
that
there.
how you do it?
Yeah, it connects from here to there.
And all it does is it's set up for that.
Yeah, it's like you have the little, the little,
Yeah, set it up.
what do you mean?
No, you have that to
Yeah, just to change the slide. So there's just going through and you can change the slide and then, because usually they say, Carlos, next slide, Carlos, next slide. Here, they can actually just,
yeah.
Instead of
They
messing-
got all these things, probably doesn't even cost that much. Probably
It was like
$25.
no, like $15 or
Yeah,
something.
I mean
And
nowadays.
this is what I use for my class, for my training.
Oh, do you?
Yeah.
Oh, so you
So-
look impressive.
No, it's just easier instead of having to go down.
Yeah, no.
So Karam saw me with this over there and he bought one for him for when he brings his clients in, or he's doing videos or something.
Yeah, yeah.
So he's like, I love this thing. I do too. It's awesome.
Yeah, that's funny. That's great. How'd you discover it?
Well, I know they have the little clickers that you can buy, and I was looking for the different ones, and typically they're like a little bit long,
Yeah,
but I saw this one, and that's pretty cool. So I bought it, and you just wrap around your finger so you're not holding this long thing.
Right.
Yeah, I just tried it and it worked good. Yeah, I wanted to buy one for the classes when I do this.
Someplace else.
yeah, how neat.
I think I can eat.
No, it's
up. It's a quick 150 per person.
Okay, he asked me the same thing.
Having some drinks and just having, splurging on food and maybe getting clothes.
And also video.
Good morning, how are you?
Fine, thank you. How are you?
There's food back here, Alton. Okay, great. You're hungry too, Samantha? What's food? Not sure. I'm not sure. Takes it out. There we go. How are you? Good. Okay, weekend. Good. Lots of fun. No issues? Yeah, no issues. That's fell once, frequently a little bit. No, I just like, still was out there, so it's still one of the first 2 days, then the day of the Super Bowl, and then yesterday. So hanging out. Yeah, because I'm sure he's not still. Yeah, he's not. Has he recovered completely from the injury? No, so I think next year he's gonna try to learn how to ski. But he can't do anything like that right now because if people were to fall, they're still injured. Yeah, it's not. It's like, yeah, maybe next year, but this year it's like. So me, Brandon, still, Giuseppe. Yes, exactly. Peter's little brother came too, and then that was all on farm for him. Another condo was like complex next to that was the yeah, it was. And got the weekend off. Yeah, he did, exactly. So I think he was happy about that. It was a lot of fun. So snow just as good. Yeah, it was actually. So I mean, it didn't snow for the past like week or something like that. So I hung out, we could see everybody. Everybody happy, so it's good. So I didn't look through the presentation, but questions that I would ask after the presentation in regards to rental real estate and if you're a solicitation or not. So maybe that's fine. I don't have that yet, but I did add in the thing about I just talked about no, that's good because that's what people are if they finally be able to see, which makes sense. So then yeah, we can talk about this. So I think it's like Q&A, but I think no, I can still yeah, that's 45 minutes. Yeah. My best.
Hey everyone, hi.
Medical.
Hey. Morning, Jay. And did you get my email yesterday?
Oh, no, I couldn't not.
Oh, you're kidding.
Yeah, I had my old email.
Am I going into your junk folder? I'll send it again.
Okay, so anyway, I don't, yeah.
I did not forget it, but I want you to know that.
Okay.
No, it's like, maybe you decide we'll probably go back. Good to see you. I'm good.
John will be here.
Hello.
Hi, how are you?
Good about you?
Good. Glad you're talking today. I never come to these meetings, but
Oh, you don't? Okay.
Me neither, so see?
Yeah.
you don't either.
I know, look at him, right?
How have you been?
Good.
Yeah.
The one that I talked with you about when, actually it's Myra Hazelrig, you probably don't remember, it's been a year ago, but anyway, I can't get them to sell, like the husband is dementia, just simply does not move, so I won't move.
That's so hard.
It really is.
Yeah.
Yeah, and she's just at the end of a rope, you know, she just. Yeah.
Yeah.
So I have a question.
Yes,
When somebody, like you can add the improvements to the basis, right?
yes,
Okay, so that would be like adding a deck, right?
yes.
But how about redoing the wood floors?
So, yes, so anything that technically has a useful life, the easiest way to think about it, if something's gonna have a useful life of more than 1 year, technically that's a capital improvement and not a repair. So you can look at it from that standard, or if you just are expensing something to bring it up to like the original status of it. So like, they say, oh, it's gonna last for another 5 years, but people will just paint it to bring it to like its original status. That might be a repair, right? So it kind of just depends on exactly what they do, how much they put into it, things along those lines. So it's like flooring, yes, you could say that's a capital improvement. If it's not changing, or if it's not just bringing it back to like.
You're fine,
original
Rick.
state, right? If it's like a change from what it was originally, then you can add that to the basis. So most items like will qualify, but then there's like some cursory items like paint, like some carpet, things like that, where the IRS might say, well, this is really just a repair and not a capital improvement. Then you don't have the basis. So.
Good
Yep.
to know. Thank you.
Yes, you're very welcome.
Glad you know everything.
I wouldn't say that, but hello, how are you? Good, good.
Can you guys hear us at home? We can't hear you.
Yes, yeah, we can hear you.
Okay, we got you. Thank you. Because they have questions.
Yeah, that's fine.
All right, so we're good.
Okay. We replaced the projector.
Center was really bad.
Oh, really?
Yeah.
Oh, and then Carlos, if somebody like types in a question, do I just like exit out of the screen?
I'll just read out the question.
Oh, okay. That's even better. Thank you.
Even though the weather's not conducive to the barbecuing.
Hello. Alton, nice to meet you. I don't think we've met. Yes. So I'm an attorney and a CPA, so I do a lot of tax. Yes.
Geez, okay, I love it.
Many things, but yeah, mainly tax.
Tax due.
Yeah. Trust me, I know. Yeah.
But my food came. Hopefully I
Yes, it
didn't-
did. It did. He's
gonna have a
question on opportunity zones.
All
Oh,
right.
yes,
Okay. Happy to help.
that's great.
We're kind of going out of style, but yeah.
Yeah,
So,
still existed.
yeah, they still exist, but a little out of style nowadays. Like they were huge. 2018, 2019, and then some of the benefits, I'm sure you know this, but some of the benefits started to phase out, so people don't use them as much, I would say. But there's still some good benefit behind it. So
Hi, how are you? Happy Valentine.
Yes.
Rosie.
I've got the
Just
gear
like
on.
this.
yeah, exactly. I don't have any red. My son. Yeah. That's right.
Yeah, every night.
Did you like seeing the people online? Oh, no, actually,
You don't?
that's okay. Carlos said that he was gonna look at questions as they come up and then just read them out too. So.
Please, my heart.
Yes. I'm
Well,
giving you
looking
my
forward
heart.
to it.
All right.
Yeah.
Here's Brett.
I thought so too.
Didn't he remind you of, do you ever listen to Russian?
Yeah.
I swear, that's why it's really because voice wise, I couldn't believe it.
No,
I know, right?
You know, he, like, I've been in this thing for 37 years, but he was teaching way back then.
I should.
He kind of worked himself.
Want to do-
Times the workshop.
I want to do a.
Teaching classes, or it sounds like.
So it depends on the context. You want to go estate planning.
Yes, you look into your profile and it'll, I'll be able to see whether or not it's been signed off. Yes. Exactly.
But if you have a card, I can send you. Here, I'll just put it right on top of this, so can't miss it. But like, so there's time with 2 days. One of my police based, so it's a lot of
Valentine's Day.
sales, what they're saying.
I see. So you're celebrating for that, but not for me. Okay. What do you mean? What do you mean?
Yeah. Do
that.
I work on too, and there's such a change, so. Very special day. Like those shoes.
Thank you.
So good.
Thanks. I kind of like seeing the faces on here, right? And we are live, by the way.
Oh, okay.
I just.
Say anything you want about John Barrist. He's not on yet? I don't know if he is. I can't see who's on the way the screen is at the moment.
I know, are you, aware of hearts? I have an alternative mode. I'm into the comfy look now. If I can help it, if I can help it.
Well, when it's cloudy out like this, you know.
Well, you think, you guys are young. You have no idea what it's like to wear pantyhose and high heels. Back in the
You're right, I
day.
have no
we used
idea.
to have-
Hello. How's it- Good about you?
Good. Oh, my God.
Hello, good to see you.
Gina, turn on, right?
Yeah, so he said, once you click it, but I think it's already working too, yeah, so.
It's kind of nice.
Actually, nobody's actually given me one of these before. I usually have to like set up my own computer
Mhm.
and like do it, but.
You make your life easy.
And there's red laser pointers,
There's a
so
laser pointer
Yeah.
too. Exactly.
now I just need to have my cats here, keep them entertained.
Yes. Yeah. Good luck with that. It was funny the last time we were out of town and we went higher. You and Jenna were. They both came downstairs. But
Yeah.
then Whiskey got on the first landing and Mary Ann was gonna.
Yeah, that just doesn't work.
Whiskey wouldn't even move, right? So walking by was treacherous.
Yeah, yeah. Actually, if she sits there, she probably won't smack you as you walk by her. It's like trying to pet. Like, I think she knows the difference, so. But we're actually bringing both this weekend. Because we're gonna go out Sunday, and we're gonna stay there for the whole next week, and then come back the following Sunday, so. At our house, there are these 2 huge carriers that we're gonna put in the car, like strap them in. Because Jenna wanted to give them a lot of room for that. So we'll see how it goes.
The whole family.
I know. Well, I do want to see the snow. I want to see that reaction.
Of course, of course. So I'm not sure. Hopefully we'll see you.
Yeah.
Yeah.
But if I like stand right here, right?
Yes.
Okay.
It's 1, 4, 5.
I'm gonna introduce Rosie first.
Oh, thanks for doing that.
Oh, yes. I just started editing it, but I'll show you when I start.
Hello. How are you?
Are you?
Yeah.
Hopefully you got a good time.
Yeah, so there might be me and my friends, right? Right. There you go. Thank you.
I'm gonna go grab a bite.
I know.
Oh, I'm good.
How's it going? Good to see you. Good to see you too.
See you all the time.
I know.
We'll move in.
Yeah, I just got to put my names on one of the stations, right?
Yeah, yeah.
Just kidding. What, have you been? Oh, that's great.
You know what? You remember Markel?
Yes, I
He
do.
moved out there, so he ended up meeting us and we went out to dinner.
Oh, very cool.
Randall, bridge, so we got to see them.
Yeah, no,
He and his wife.
Nashville is very cool. Like, it's a unique city in of its own, I know.
Have you been there?
Yeah, Jenna's grandma actually, so she retired out there several years ago. So like we just go visit them, you know, and it's they're very into like the whole country /
Good morning, everybody.
Good morning.
Whoa,
Good morning, happy Valentine.
Yeah, happy Valentine's Day.
Valentine's for everybody, that's right.
You know, initially we weren't sure if we could hear you till John's voice came booming over the speakers.
As it should.
That's that distinctive voice. Everybody had their food. Valentine's Day, happy Valentine's Day, everybody. And Rosie, thank you so much for bringing in breakfast today. For those of you that are here, let's thank Rosie. So let's start off with introducing Rosie Poole, First American Home Warranty. Come on up, Rosie.
Am I on the right X? All right.
Can she stand on a box?
Okay, is that better? Yeah, I know, I'm short. Okay, so thank you guys. I just want to thank you guys and tell you how much I love you for giving me the orders. I'm on commission just like you guys, so I appreciate that. Remember that prices will be increasing in May. So when you're writing your offers, make sure you're writing in enough. If you're not sure, please reach out to me because there's enhanced options. We're coming out with a 4th policy because the prices and the homes are a lot more. We need to align the home warranty with the price of the home. All right. So please keep that in mind. If you run into trouble on a claim, please reach out to me. Email is best at rpool@firstam.com. So that way I can address the issue. Do I need to send a second opinion? Or maybe I'll even have your own tech go out there and dispute what my tech has said. That way we could push the claim to a close. Home warranty is a process. The difference between retail jobs is you ring a ding ding 5 times higher, you're paying for the repair. Home warranty, we're regulated by the state of California, so we have to have a paper trail of what is going on and transpiring. If we don't, it's called money laundering. So with that, please let me know how I can help. And I gave you guys cookie cutters. There's a recipe on the back. Please make those cookies and let me know when they're ready. I'll be right over.
Thank you, Rosie. Appreciate it. So unfortunately for us, it's tax time. For our speaker, it's the perfect time of the year. It's like going to the dentist all once. So our speaker is both an attorney and a CPA, and I've asked him to talk about real estate related activity, specifically for real estate professionals such as yourself and investors. So let's please welcome Alton Moore.
Hello, everybody. Lots of familiar faces. Good to see everybody here as well. So Rich is right. We are going to be talking about entities. We're going to be talking about some tax topics that are really applicable to I would say this presentation is more geared for you guys. Yeah, I will talk about your clients as well for those who are real estate investors. But the gist of today is we're going to talk about different types of entities, which you guys should be thinking about, how you can improve your own situation, how you set some of the things up, and just like different considerations as well. And then so we'll go through a bunch of different topics, and then at the end, there will be a Q&A session. If you guys want to stop me, just raise your hand. I'm happy to stop and talk about a question you might have. I know Rich said he already has a long list of questions to grill me in front of everybody by the time we're done here. So please be prepared for that as well. But thank you for having me. So let's jump right on in. Oh, that's the laser pointer. All right. So as Rich mentioned, I'm an attorney. I'm a CPA. I primarily practice tax, but I also practice trust and estate planning and business law / entity formation. So if you or your clients ever have questions in any of those fields, please feel free to reach out. I do provide free 15-minute consultations. So a lot of times I get agents who may have a client with a question and they want to set up a consultation with me and their client. So I'm happy to facilitate that. And you guys can just reach out to me via email. There's ways to access those links on my website, which there will be at the end of this presentation. But just remember, I do provide free 15-minute consultations as well. All right, so the purpose of today's presentation. So I'm hoping from today, you'll be able to walk away with a few high-level points about different entity types that we're going to talk about, tax consequences, and there will even be situations in which you could provide your clients additional value for issues that may come up that they're facing. And then, so that would primarily be for real estate investors or just even owners of their own primary residence as well. So what we're going to talk about, and I'll explain this a little bit longer or a little bit more detail as we get into this. There's a difference between legal entity type and tax entity type. So if you were to set up an entity, if you're a sole proprietorship, you may be taxed underneath a different version underneath the tax code, or vice versa. If you have a corporation, you could be taxed as an S Corp or a C Corp, right? So we'll talk about these legal entity types that you would choose if you wanted to form an entity or hold real estate in, and then the tax actually concept that you would apply to as well, and the consequences therefrom. All right, so in each state, there are various differing types of legal entities. There's 4 main types, which I discuss here today, but each state has its own variation on or spins of these. So the one that you guys have probably heard of the most, or that's most common to you or even your own clients, is a sole proprietorship. So that's just a person who just starts conducting business or conducting activities for the motive of profit, right? So there's no actual legal entity type. Your name goes on those contracts, or if you get a DBA, that's what you would put on there. But technically, you have no formal legal structure, no legal liability protection. And for tax purposes, anything that you earn goes on your Schedule C on your individual return. Now, the next one, and another very common one that you see in the context of real estate holdings, or just even operational businesses, is a limited liability company. So this is an actual entity that has to be formed underneath state law, right? So to form it, it's generally pretty simple. You go and prepare this thing called Articles of Organization. You would file it with the applicable Secretary of State. And then after a few days, depends on what state you're filing with, you'll actually get a notice back from that Secretary of State saying, hey, you've got your entity and here's your certificate of organization. Now, an LLC in of itself, and the main purpose of why most people use it is right in the name. It provides limited liability protection. So unlike a sole proprietorship, if you were to operate underneath an LLC, or if you own a piece of real estate in an LLC, and let's say you have a renter who slips and falls, and now they want to sue you, they actually have to sue the LLC. They can't sue you personally. So why that's important is because they can only reach the assets of the LLC. They can't reach any of your personal assets, such as your vehicle, your home, your bank accounts, right? Only anything that's in that actual entity in of itself. Now, for a corporation, this is relatively similar to a limited liability company, and I'll talk about some of the differences here for the more specifics. But again, it's an entity that's formed underneath state law, and like a limited liability company, it does provide limited liability protection. However, the operating form is a little different, right? So you're actually going to have stockholders who appoint directors, who then appoint officers. But with a limited liability company, you just have owners who are called members, and they're typically the managers, and you don't actually have to appoint anybody else unless you want to employ them as well. And then the final one that you'll see is a partnership. So the way you can think about this, a partnership is kind of like a sole proprietorship and a limited liability put together, and it has various forms underneath state law. So with the partnership, it can be formed without actually filing something with the Secretary of State, which is kind of scary. If you have two people who start operating together for the motive of profit, this entity's formed, which is odd. So the way I always learned about it, or my law school teachers taught me about it, is like if you have two kids who are running a lemonade stand, technically they have a partnership, right? It seems weird, but California law says so. Now, most of the time, you're not going to find that sort of partnership. And that's because that would be a general partnership, which doesn't provide any limited liability protection, right? So the people who are the partners are going to have the liability for the debts and obligations of the company. More typically what you see, and specifically in real estate, is a limited partnership. So that's where you have one person called a general partner who actually manages the day-to-day, and you have limited partners who just put in money and they're passive investors, right? They all get a K1, but those limited partners have that limited liability protection where the general partner does not. Still in that case, the general partner has unlimited liability protection. Not to get too much in the weeds, in those situations, you'll see somebody form an LLC and then be the general partner. So they have that limited liability protection, while all the other limited partners are just individuals that put money into the deal into themselves. Okay. So now to get into some more of the specifics and things that you need to think about. So sole proprietorships, we talked about them, right? Really, it's just an individual who starts running a business in their personal name. Maybe they have a DBA. Typically, sole proprietorships are the easiest and the cheapest to start running. And that's why you're going to find most of them in this fashion. There's no state filing fees. There's no separate tax returns, right? Anything that sole proprietorship earns goes on the individual return of the person that's running and owns the company, right? The only thing that you might find is a DBA. So if you are a sole proprietor, like my name's Alton, right? And if I wanted to operate, underneath like a cups company, because I make cups, I would just go to the local county. I file a DBA, which is about $25. And then I get to start signing all those contracts and start actually running my advertising underneath that separate name. And you can have multiple DBAs. So I could have DBA 1, 2, 3, and 4, and you guys actually might see that on some of the contracts that you enter with other parties as well. Now, there is also minimal government regulation oversight on sole proprietorships. And the reason being is because, again, there's no separate tax return filing besides what goes on your individual return. Every single year with all those other entities I discussed, you actually have to file annual returns or statements of information with the Secretary of State listing, who the owners are, who the members are, who are the officers, who are the directors. So they have a lot of information that's publicly available, right? So anybody can go on that website and see that as well. And then beyond that, the only thing you really have to think about here is that maybe you'll get a DBA and you re-up that once a year with minimal amounts of fees as well. And also sole proprietorships, unlike an LLC or corporation, like in the state of California, in addition to having those annual filings, at a minimum, you have to pay $800 a year, right? Whereas with the sole proprietorship, there is no such recurring costs as well. And then the final thing here is the ownership and management flexibility. Now, that kind of is in of itself, right? You have a single person who owns and operates a business, you make all the calls, right? You're not subject to anybody else's discretion, like their management, their voting rights, right? It's all contained within you. Whereas with these other sorts of entities that we're going to talk about, there is like a formal structure in place with voting rights, annual meeting requirements, when you can make decisions, when you can't, that aren't applicable to sole proprietorships. Now, the last thing I don't have on here, but that we will talk about a little bit later as well, is taxing. So, and you'll see for specific reasons why sole proprietorships out of all these forms is likely to be the least or the least favorable form of ownership. And that's because you're going to have self-employment tax. So if you guys are 1099 and you file a Schedule C, every single year, you're going to pay about 12 to 15% of self-employment tax on top of ordinary income tax as well. And there's some things that we can do through forming one of these entities that can actually reduce that as well, if not eliminate it completely. All right, limited liability companies, right? So the big thing here, and I talked about this already, the reason why people form these and operate their business through them or own real estate through them is limited liability protection. If you get sued, only the entity can get sued. They can't reach your personal assets, right? So you could think about it, even though you're paying $800 a year to maintain this entity, it's a very cheap insurance policy, right? Because if you're going to get like $1 million of like umbrella coverage, maybe you're looking at $1,500, $2,000 a year. It could be more in certain situations. Whereas the LLC, now maybe you don't have the insurance coverage for certain sorts of liabilities, but their recovery is limited to only those assets inside there. Whereas with a sole proprietorship, they'll go after your personal house, they'll go after your cars, they'll go after your bank accounts, right? So this is the main reason you're going to find that people form LLCs. Now, the second piece of LLCs is their flexibility to elect tax treatment. So for LLCs, again, it's an entity that's formed underneath state legal liability law. LLCs actually aren't recognized as a tax entity. So for LLCs, they can be taxed in one of three ways, right? Or I'm sorry, four. So you could have a disregarded entity, and we're going to talk about all these four later, so you don't have to worry about picking all this up right now. So disregarded entity, which is essentially an individual, could be taxed as a partnership, as an S corporation, or as a C corporation. So when you have one of these, and you're going to have multiple owners, it allows them to elect a tax treatment that's more preferential for their specific situation, as opposed to being compliant with a deemed or mandatory sort of tax treatment from the IRS's perspective. Then the final piece here, again, so now LLCs are not as flexible as sole proprietorships, right? Because a sole proprietor, there's one person. They're not subject to anybody else's thoughts or views or voting rights. However, LLCs in themselves are still pretty efficient. Now, if you have one owner of an LLC, that person's still going to make all the calls, right? So they're not really subject to anybody else. But typically with an LLC, you have 2 or 3 owners. They're all going to be want to be part of the management team. So typically you're going to have the owners who are also the managers, and then there will be an operating agreement which will define their voting rights and when they could take specific actions, right? So within that, typically, you're not going to need somebody to approve you going and doing like the day-to-day activities of the business. Now, what you would need is if you wanted to sell large amounts of assets of the business, if you wanted to dissolve the company, there are situations in those operating agreements which do require unanimous vote or consent from all the other members as well. Okay, corporations. So these are more similar again to LLCs, right? They do provide limited liability protection. So again, the owners or the shareholders can't be sued personally, only the corporation in and of itself can. Corporations like LLCs, they do have the ability to elect tax treatment, but it's very limited. They can only elect C corporation or S corporation status. And we'll talk about those two in a little bit. Now, corporations, you can think about these as big from an ownership and management perspective. They're big organizations, right? So for a corporation, the way that it works is that you actually have shareholders or stockholders, right? They own the company. Those shareholders and stock owners then have to appoint the directors of the company. The directors oversee the general view of the company, its long-term goals, right? And then the directors themselves, they appoint the officers who manage the day-to-day from it. So if you wanted to make a large change at the officer level, you'd have to get shareholder consent, right? Who would then replace those directors, and then those directors would then have to replace that officer. Whereas with an LLC, the owners are the members or are the managers, so they can make those changes as they see fit, right? So corporations just tend to have a lot more lag time between for making major decisions within the context of their business. Okay, and the final item we'll talk about here are partnerships. So we talked about this. You can have a general partnership or a limited partnership. General partnerships do not have limited liability protection. So that means the 2 people or 3 people who are running the company, they can be sued personally, or they are going to have personal liability for the debts and the obligations of that business. Whereas limited partnership, you'll have limited partners who can only be sued up to the amount of their investment in that partnership, and their personal assets can't be reached. So for limited treatment, I did just talk about this. So limited partners, they'll get limited liability protection, but for tax purposes, partnerships typically will only be allowed to be taxed as partnerships in themselves. And there are certain contexts where they can be treated as something else for tax purposes, and we'll talk about that in a little bit. But it just does provide the owners a lot less flexibility in what they can do in structuring how the owners can actually compensate for negative tax consequences from the purposes of running that business. Yes.
So a lot of times we have individuals who want to partner in acquiring the property, and they have no formal documentation indicating if it's a partnership, that their intent is to be a partnership. So could you just address that in regards to what the implications are for each individual?
Yes. So if that is the case, and even if there's no formal agreement in place, if there's 2 people operating for the motive of profit, technically they formed a partnership underneath California state law. So there's 2 things that come from that. Even if they don't have an agreement, California has statutory rights for partnerships that are deemed to be created, or general partnerships. So that's voting rights, distribution rights, liquidation rights, things along those lines. So if that's a case that they don't have an agreement, then they actually have to operate their partnership in context of California general partnership law. Now, secondarily, what they might not realize is that they also have a tax partnership, meaning that they need to start filing partnership tax returns for the operation of that business as well. Now, the IRS has a harder time finding out about that just from a practical perspective. So maybe they can get away with it. And there are certain exceptions in the context of real estate ownership where you have 2 tenant and common owners, where you can set up the agreements appropriately so you don't have a tax partnership. But that's very hard to do, and you have to actually pre-plan for that. So I think that answers your question, though.
It does.
Okay.
Yes. So the best approach would be to get an agreement.
Yes, if if your clients are ever thinking about this, get an agreement in place, because if not, that things and partners tend to fall out at a later date in time, and that's when litigation arises. And so you want to have those rights predefined before you actually go into that. So
Is that something you can help with?
yes, it is. Thank you. Good question. And then the last thing on this is just the flexibility and management of a partnership. Again, if you have 2 partners, and it's usually defined within the terms of the agreements, those partners generally going to have equal voting and management and membership rights over the business in of itself. There are certain times when you're not going to have that. So like for a limited partnership where you have 1 general partner and 1 limited partner, the general partner is going to run the day-to-day, and the limited partner is just going to sit in the back and be the money person, right? And if they step outside that role of that limited partner where they actually start to operate in the day-to-day, then they could actually become liable for the debts and obligations of the partnership. So they don't get that limited liability protection any further. So. Okay. So again, so those are general legal entities you can form or operate as underneath California state law. However, they are all going to have different sorts of tax treatment underneath tax law. So you have to think about these things in 2 separate realms, right? You have general state legal liability law, entity law, and then you have actual tax law and tax treatment. So within the confines of what we're going to talk about today, and there's 4 general entity types, right? So most of you guys have heard these. There's a C corporation, there's a sole proprietorship, which is just an individual. There's a partnership, and then there's an S corporation. So some of those entities we talked about before, so like the LLC, they can actually make an election to be treated as any 4 of these, right? They can be any 4 of those depending upon what their preferential treatment is. Whereas a corporation, they can only be elected to be treated as a C corp or an S corp. And then if you have a partnership, right, they can only be elected to be treated as a partnership, but they do have some flexibility in certain situations to be treated as an S corp or a C corp, but that's very far and few in between. But we'll talk about the advantages of each of these in a row or here. So a C corp. So typically this is reserved for larger companies. The reason being is that it is a separate entity, right, for tax purposes. A partnership, a sole proprietorship, and an S corp for tax purposes, you'll actually have a annual return filing, but the IRS says all that income that comes to you hits your personal return. But the C corp, that's not the case. It files its own tax return and pays its own taxes. So a C corp, it actually would be, so like if it can't pay its own debts, the IRS can't go after the owners. They can only go after the C corp in of itself. Whereas with those other entities, the IRS can go after the owners if they're not able to pay the associated taxes, right? So a lot of times in what people think about C corps is that they're going to have a lower tax rate. So a C corp, as you guys might know, has a 21% tax rate for federal purposes. I think California is sitting at about 8.84% right now. Now, whereas an individual, their top marginal tax rate for federal purposes is 37%. For California, it's 13.1%. So just from that fact, you might think, well, okay, C corps are going to give me a lower tax rate overall. That's not the case, right? Because that's the tax that only the C corp pays. When you take money or profit out of a C corp, it's typically taxable to you as a dividend, right? So that means the C corp, let's just take $100 here. $100 in net income pays a 21% tax rate. So now it has $79 left. Now it distributes out $79 to the owner. That owner has to report that as a dividend, which depending on your top marginal tax bracket and the type of dividend, it's going to range anywhere from like about 15%, could get all the way up to close to 40%. So 2 layers of taxation. So it always sounds good at first when you're going to have a C corp, but there is a layer of double taxation, which makes it super inefficient. Now, the reason why somebody would choose a C corp is when you have a very large organization and the owners themselves cannot handle or maintain the responsibility of paying those taxes. So in the context, and we'll talk about this, so like an S corp, you guys may know this, but any income that's earned by an S corp flows through to the individual's income tax return. So you'll get a K1, right? That tells you your share of the income or loss that hits your personal return. Then you actually have to take distributions out of it, which aren't taxable again, to pay those taxes. Where as a C corp, if you had that same instance, it was a really big company and you had all those incomes flowing through, that C corp, if you don't own it as well, may not make distributions to you to actually pay those taxes. So that's why you see a lot of times in the context of really big companies, they'll use C corps, and it's not really used by smaller companies or individual owners or those with just 2 or 3 owners. Okay, the next one that you guys will most typically see is a disregarded entity, or what is known as a sole proprietorship for most places. So a disregarded entity or sole proprietorship is typically when people actually have to report their income or their activity on a Schedule C as part of their individual return. So that could be a person who just starts operating as a sole proprietorship, or it could be a person that forms an LLC and makes an election to have that entity be disregarded for tax purposes, right? So you can just be a sole proprietor, or you can actually have an entity and make this election to have this treatment. Now, when you have this, you have all the income that's earned by the entity reported on the individual owner's return. So if you're actually running an operating company, that income is going to get reported on your Schedule C. Now, if you just have a single rental, right, that rental, just like as you would previously if you own it directly, gets reported on your Schedule E as well. So that's what you could think about for sole proprietorships. So now, in comparison to a C corporation, there's no double taxation, right? There's the entity's disregarded. You don't actually have to file a separate return for it. Everything that it earns goes directly on your personal return, and you only have to pay tax on it once as well. So it's always more preferential from that perspective. However, comparing it to C corp, right? I keep saying it's a 21% tax rate, but as you guys now know, it's a misnomer. So the highest marginal income tax rate of 37% for federal purposes could be applicable, but I think for 2023, I think a married couple has to start earning over 500 to 700, somewhere between 500 to 700,000 before that actually becomes applicable. So you're really not going to hit that marginal tax rate or the highest one until you get pretty high up there. Whereas a corporation's 21% tax rate it's a flat tax rate. So it doesn't matter how much you earn, that's always going to be applicable to the income. Now, the thing about sole proprietorships, a lot of this sounds good until we get to this very bottom line. So self-employment tax. So if you run a sole proprietorship, when you report your Schedule C, all that income there on there becomes subject to about a 15% tax between federal and state. And so that's on the net income, right? And there are really no ways to plan around that, except for when we talk about S corporation here in a little bit. By forming an entity and treating it as an S corporation, you can earn that same income, have it come through free of that same 15% tax. It's a very simple way to avoid this. And that's why you see a lot of small business owners actually form and operate their business as an S corp as opposed to a sole proprietorship.
Can I just add something?
Yeah.
And where a lot of this becomes really applicable for us in a transaction. For many individuals today, they may be non-resident aliens. So if they're selling a property, they're subject to withholding. Now, the question comes up, if it's an LLC, is the LLC subject to withholding? If the LLC made the election to file as a disregarded entity, something that goes through to the individual's private personal tax return, and it's an investment property, they're going to be subject to withholding. And if it's an LLC that didn't make that election, it's going to be based upon where that LLC is domiciled, correct?
Yeah.
So if it's not in California, it could be subject to withholding once again.
Yep, that's right.
Then what's the percentage of that withholding?
If the selling price is over $1 million, it's 15% federal and 3 1/3% state. $1 million and less, 10% federal, and still 3 1/3% state of the gross selling price. So we have unhappy clients that are non-resident aliens having a substantial amount of money withheld from the proceeds of their sale. So it's something to give consideration to. Remember, they can buy property without a taxpayer ID or be a non-resident alien. They're only necessarily impacted when they sell that property.
Yeah. And
you actually can assist people with that.
well, and so I think you're talking about, so there's federal withholding, right? For
Yeah.
just like people who live in the US along with California. Then what you're talking about for non-resident aliens, there's this thing called FERPTA and FDAP underneath US law. So essentially the US, if you have any sort of passive income, they apply a 30% flat withholding tax on the gross sale proceeds that you would receive. So this applies to real property, right? So if you have a non-resident alien, you can file certain sorts of exemptions that rely upon the application of a treaty. There's a number of ways to go about it, so that you can either reduce the actual withholding to 10 or 15%, or you can even reduce it down to 0% in certain situations. So yes.
When you say withholding, does that mean that they obviously they take the money away, but you get?
Yeah, so you do, yeah. So withholding, so it's a withholding tax, right? So it's not withheld from the net sale proceeds, it's withheld from the gross. Now, most of the times you're going to be overpaid in tax, right? At that point. So you get a refund, that person actually has to file a tax return at a later date. So this becomes a big issue, especially for non-resident aliens, because most of the times they're not going to have an I-10, right? Or a social security number. And then, so they're going to have the tax withheld from them, and maybe they will have applied for it, but they won't have it. And that gets messed up in the IRS's system. And so then they actually have to file for a tax return later, still hopefully get that item before then. So the IRS will actually issue the refund as well. So, yeah. And there's a lot. So the IRS since COVID has, I'm sure you guys have heard about them trying to hire 85,000 people and staff, right? And then now there's like bills against it, all this stuff. Well, it hasn't been passed to like pull it back, but they still actually haven't hired those people to process, or like for agents who would just not only answering your phone call, but to process different sorts of filings, such as a W-7, which is what you need to file to obtain an I-10. And so I even have like several clients who we filed for I-10s in February of last year, and the IRS has still not processed those items. So not only do they have a 2021 return that's sitting in limbo, now they're also going to have a 2022 return. If we have to file it by April 15th, that will sit in limbo, and they actually won't issue those refunds until those I-10s get processed as well. So
if you have a client that's a non-resident alien and they hope to avoid withholding from this selling proceeds, sales proceeds, it could take more than a year.
Yes.
To get that taxpayer identification number to prevent any withholding.
And the only way to avoid that is if they go into an IRS service center in person. You can get it issued that day or within 2 weeks if you go in person, but it's not actually practical for a lot of people because they actually have to fly to the US, right? And they have to go to an IRS service center here, bring all their documents with them, which, just from a practical perspective, it's always sounds much easier just to send in an application with a copy of your passport and all these things. So that's just one thing. You can get around it, but it does require a lot of legwork as well. So. Yeah. Thank you. Yeah. Okay. See, already went that way, right? Yeah. All right, so partnerships. All right, so this is another sort of tax entity. So this is again similar to a sole proprietorship, except for it's now going to have its own separate tax return filing. So if you have a partnership or a tax partnership, you would actually file the entity tax return on a form 1065 each year. That's due by March 15th, so that's coming up relatively soon. And then for the partners, once you actually file that return, because this is a flow through entity. So that means all the income passes through the partnership and hits the individual owner's returns. It issues them a K1, right? So that's something like a 1099 or W2 you might get. It just tells you your share of income from them. So like a sole proprietorship, there's no double taxation. So when a partnership, as it earns its income, right, it reports it to its owners on a K1. Then what you can actually do from there is once you've earned that income, you get to distribute it out to the owners on a tax-free basis, which is not true of C corporations, right? So with the C corp pays and files its taxes individually. Then if it makes a distribution, those are taxable as dividends to the owners. Whereas with partnerships, you do have that separate filing, but since that income has already flowed through or passed through to its owners, you actually don't have to pay tax on it again when you distribute those earnings out to the individual owners. So again, like sole proprietorships, the income tax rate can from the get-go look like it may be higher than what you have for a C corporation, because C corporations pay 21% tax, and the income that flows through from a partnership can be subject to tax at a top marginal rate of 37% at the individual owners levels. But again, when you pull that money out of a partnership, it's not subject to tax again. So you only pay it once. Whereas with the C corp, even though you've paid a 21% tax rate, when you pull that money out in the form of a dividend, you have to pay tax on it again as if it is a dividend, right? And then the final thing here too, so depending upon the partnership's activity, right, it can be subject to self-employment tax, right? So typically rental activity is not subject to self-employment tax because it's not viewed as being an ordinary income trader business, right? It can be for certain people, but it won't be. But if you have like just a general operating business, 2 people making widgets and selling them, any of that income that flows through would be subject to that 15% self-employment tax. And again, the easiest way to avoid that is to make an election for the entity to not be treated as a partnership, but rather as an S corporation. Okay. And then the last one here, so S corporation. So typically, this is going to be the best scenario or the best entity structure for a smaller business, right? It could be anywhere from 2 to 5 owners that have smaller amounts of revenue, and those people are able to actually pay off the taxes as they come due from the earnings of the S corporation. So again, like a partnership, it's like a flow. It is a flow through entity. So all the income that's earned through an S corporation flows through and is reported on the individual owner's return each year. This return again is due by March 15th. When that's filed, the S corporation actually issues to its owners a K1, right? So you're reporting, you're getting reported the amount of income that you are earning, and you need to report on your personal return via that K1. Like a partnership, there's no double taxation, right? So once that income flows through to the individual owner's return, right, you can actually pull those earnings out tax-free without having to pay tax on it again, which is unlike a C corporation. So S corporations, like partnerships, it sounds like their tax rates can be higher because it flows through to the individual's return, where C corporations have that 21% rate. But again, it's a misnomer because when you pull those monies out, you're not paying tax on it again. You've already paid tax on it once. And then the final thing here, and the reason why most people will use S corporations as opposed to like a sole proprietorship or even a partnership, is because there is no self-employment tax on that flow through income. So that same income that you've been getting through a flow through from, a partnership, or you just earn your personal name as a sole proprietorship, that income subject to 15% tax. Well, with an S corp, that same income flows through free of that 15% tax. So just by forming an entity and making an S corporation election, you can actually reduce your overall tax burden by 15%. Now, that's a bit of a misnomer, because when you have an S corporation, the owners actually have to pay themselves some sort of payroll, and that's called reasonable compensation. Now, for an example, most of the times owners can get away with paying themselves 1/4 to 1/3 of their net income to themselves in the form of payroll, which is subject to payroll tax, which is almost equivalent to this 15% self-employment tax. So as an example, so say you have an owner who's a sole proprietor, they make $100,000, right? When they report that activity on their Schedule C, not only are they going to have income tax, right, which they're probably sitting in that 20-25% tax bracket rate, then they're also going to have self-employment tax on that full 100,000 of $15,000, right? Now, let's say the same owner decides to form an LLC and they make an election to treat it as an S corporation. So now they're going to have that same net income that they're going to pay on anywhere from 20 to 25% income tax on, but it's no longer going to be subject to 15% self-employment tax. So it's about a 15K reduction. Now, again, we have to talk about reasonable compensation. So in that scenario, they could probably pay themselves anywhere from $25,000 to $35,000 in the form of a W-2 wage or salary. And that portion will be subject to the 15%, or an amount that's essentially equivalent to that. However, the remainder of it comes through free. So just by using an S corporation for smaller businesses, as opposed to using a sole proprietorship or a partnership, you can avoid the actual self-employment tax. So that's why you see these very commonly used. Oh, yes.
So as I'm understanding, you could have either an entity as an S corp and then choose your tax form.
Yeah, so
Most people do S corp and then choose S corp, or go limited liability, and is there tax implications for either one of those?
so close. So for an entity like that, so an S corporation is not actually recognized under the state legal liability law. It's actually only something that's a function of tax law. So you can never go like to the California Secretary of State website and say like form S corporation. So you'd have to form like an LLC or a normal corporation. And then once you form that, you actually make an election, and it's on a form 2553. You file it with the IRS, and it tells them that you're treating that entity as an S corporation, as opposed to its general default treatment that comes with the entity of choice. So
All these other entities, who had, they can't go, with your personal assets if you have a C corp.
so yeah, so with an LLC and a C corporation or a general stock corporation, that's right. So the entity files bankruptcy, they can only go after the assets inside there. Now, that could also be true of a partnership. So if you have like a limited partnership, they can't go after the assets of the limited partners because they're only liable up to the amount of their investment. But then there's also a general partner in that partnership whose personal assets could be reached. And then the final one with the sole proprietorship, yeah, there's no protection. So they could go after all the assets from that perspective. Yes.
After purchase the property, LLC or C corporation, whatever, can we stay or leave with the property for them?
Yeah, so if you do buy a property in like an LLC, you can keep it in there, and you can also change the tax election as well throughout the life of the entity.
So just like the end of the, when we sell it, we also can get a tax person.
Yeah, exactly. So yeah, and so you can usually, a lot of entities will have default treatment, right? So like if you have an LLC that has more than one owner, by default, the IRS will treat it as a partnership. However, you would actually file like the entity election to treat it as an S corp or a C corp. So once you make that election though, you have to stick with it for 5 years, right? So it's something you kind of have to be bound by, but you could, let's just say you form the LLC and it's treated as a partnership, but then 2 years down the road, you want to treat it as an S corp. Because that's the initial election to change it, you're allowed to do it then, but then once you make that, you can't change it for another 5 years, so.
What if I just purchased the perfect time of resident for the wisdom by the LLC? Is it a good idea?
Yeah, so just speaking about using LLCs to buy property, yes. The way I usually recommend it, so it's obviously going to depend upon the number of properties and the types of properties they have. So typically you're going to want to use one LLC for 1 to 3 properties, right? You don't usually want to start to house more than 3 in there. And it's really going to depend upon the nature of the property. Just because like if you have 3 properties in one LLC and you have a slip and fall in one, they would sue the LLC and they could potentially recover against all 3 properties, right? So a good example is like I had a client that had 7 properties, like from an inheritance, right? 2 of them had their own individual like pools and they had high risk areas on the properties. So we formed separate LLCs for those 2 properties. And then they put the remainder in other LLCs where they grouped them together. Because the issue is that once you start to have multiple LLCs, each year at a minimum, you have to pay $800 per LLC. So the expense starts to become a lot. And especially like in California with like low cap rates, like, you know, you have an increase in expense, maybe it's really reducing your return. So that's why so to answer your question, it depends, right? So.
Are you asking if you can live in it? Can a primary residence be in an
Yes.
LLC? I think that's what the other
okay.
thing he was asking.
Yes, so if you wanted to, you can, but there's not a ton of value comes from that as well. So like, you're not going to get a lot of tax benefit from it. And you'd want the LLC to be a disregarded entity. So it's as if you owned it personally, but yes, you can do that as well, so.
Rental real estate losses, the cutoff, and then how to be classified as a real estate professional so you can offset rental real estate losses against ordinary income.
Yeah, so it's a good question. It's kind of nuanced. So typically with real estate, you guys would probably know this, for tax purposes, you get a paper loss called depreciation, right? So it's not a real economic outlay or expense. So the way it works is that if you put $100,000 into buying a property, each year as part of a tax deduction, you get to take 1/27th of that 100,000 and count it as a deduction against the income you earn. So not really coming out of pocket out of it. And that's why a lot of people typically prefer real estate, because it will create a taxable loss, even though from an economic perspective, you're actually getting cash in your pocket. Now, the issue is that the IRS has caught on to that. So they've created limitations on the use of those excess losses from real estate against other income you earn. So, and there are 2 ways to go about this, right? So the first one is called active participation. So if you're a person and you actively participate in the management of a rental, and that could be as easy as just hiring a property manager, right? That's all you really have to do for that. You can utilize up to $25,000 of those excess losses against your W-2 wage or salary income. Now, that ability starts to phase out as your income levels get higher, and actually phases out by the time you make $150,000. So it's not very feasible for a lot of people. Now, that's just a partial limitation. For people who qualify as real estate professionals, there is no such limitation, right? So if you're a real estate professional and you have $50,000 of tax loss from your rental real estate activities, you can offset that against all your other income that you earn without it being limited. Now, the way that you qualify for that, and the easiest way to do it, is that you have to show, 1, you spend more than 750 hours in a given year on rental real estate activities or in certain real estate professional activities, right? So that could also include being a real estate agent. And then you have to spend more than 50% of all your times between different trades and businesses in that specific one. So typically for real estate agents, brokers, property managers, it's very easy to show that, right? Because if you meet that 750-hour mark, typically you're spending more than 50% of all your time in those rental real estate activities or trades or businesses, right? Now, for an average married couple, and one where you guys might have clients, right? So you might have like a very high income client, and then a spouse that's at home as well. A lot of times this strategy can be utilized for them, where they have the spouse who does obtain their own real estate license as well. And then they start to help manage their own investment properties. And so long as they can get to that 750 hour mark, then you can qualify for the real estate professional designation. So you don't have any limitations on the loss or on the use of your excess losses from rental real estate activity. So I think that,
Yes.
okay.
So unearned rent, is that a loss also?
On unearned, oh no, unfortunately not. Nope, unfortunately not.
That's aggressive.
Yeah. I might know a CPA who would do that for you. So, yeah, I'll give you their name, but it didn't come from me. So, all right. And I think,
So simple,
That's-
simple questions,
yeah.
yes. Everybody here is a real estate professional, they own their own vehicle, so deductibility, how do you allocate or what do you suggest in regards to deductibility for automotive expenses?
Yeah.
So on and so forth, you buy a car, attribute that expense to your business.
yes.
You're filing Schedule C.
Yeah, so even if you're the most simplest way to talk about this is in the form of like a Schedule C, right? So you actually can write off either mileage or actual expenses from the use of your car in your trade or business, right? So typically, most people are going to have a car that they use for both personal and business purposes. So whatever expense route you go, because it's either based upon mileage or actual expenses, and with the mileage, it tends to shake out to be higher than the actual expense you have on the car. You have to prorate that by the amount of business miles driven, right? So that's to meetings, anything for a business purpose, except for essentially commuting back and forth from the office over the total miles driven in a given year, right? You take that percentage and you times it by the actual expenses, and you can report that as a deduction on your tax return as well. So the best way to do it, and when you have your CPA prepare your taxes, and this requires a little forethought, but one, you want to get an odometer reading and maybe even take a picture of your odometer, like on January 1, and you want to take another picture on December 31. So you can look at all your actual miles driven throughout the year. Because if you get in the audit, the IRS is going to want to see that. Second, you're going to want to keep a log of all the business miles you've driven. So that could be a calendar where you list all your activities, appointments, addresses, right? And then start to calculate all those miles. And then you're also going to want to keep a log of all your actual expenses with your vehicle. So that could be gas, that could be repairs, that's also insurance. That's also the interest on your auto loan as well. And you give that to your CPA and they'll actually run which expense you're going to get more of a benefit from, whether it's the mileage or the actual expenses. And then they'll also prorate it and take it as a deduction on your return as well. So.
Can you depreciate your vehicle? That's
Yes.
attributable to business? Okay.
Yeah, and you can also depreciate it as well. So.
What if you buy multiple vehicles? Why can't you have one car just for business?
Oh, so you can list multiple vehicles. The problem is that you have to prorate, so you have to keep track for both vehicles, which ones and how many miles you drove for personal versus business miles for each vehicle.
Delegate one car for business and have the other one.
Yeah, and that's what most people I find will do. They'll actually just have one car that they'll use primarily for business purposes. And you still have to keep track of all the mileage, personal versus business and whatnot. But if you just designate one, theoretically, you're also not using it for personal. So it makes it the calculation just a little bit easier. So.
Sort of Sean, your Ferrari. That's your
Yeah.
designation.
Yeah.
So that one coming.
Yeah.
It's tough putting your kids in there though, huh?
Yeah.
Sometimes
Yes.
my car is not working, I'm driving.
Oh, yeah.
And that's the point, right? It's takes more gas. So. Yeah, I just. There was a time when I was driving my car and then my husband had a lease of. Yeah, no, okay. Gold, electric, like the hybrid.
Uh-huh.
Anyway, I take my risk.
Yes. Yes.
Okay, so my question is, what about apps? Like if you have an app, like I have an app that I can do personal and I can do business, and can I just download that and do that myself? Yeah.
Yeah. Oh, yeah. That will work for them as well. I mean, so they're really just going to want to see total mileage, right? So, and I could just tell you from the IRS perspective, like when I've dealt with audits, they actually want to see odometer readings. So that could be in the form of a picture. It could be form of like a maintenance contract, because a lot of times they'll actually put out the odometer reading on there as well. So you want to make sure you at least have those 2 points. I don't know if your app has that ability, like to take a picture of your odometer, but I would do that, and that's the best way you can prove it.
That's the only thing I have to do other than the apps, is put the big picture of my odometer.
Yep, exactly. So,
And my other question is like, if right now I don't have a car and I use somebody else's car, and I still calculate my mileage for
Yeah.
gas?
yes, and so you can still keep track of your miles, right? So the total miles will also get you here's I guess to like back up on that calculation, right? So you're gonna have total expenses, or you're gonna have total mileage expenses, right? That you drive throughout a year, right? And then they'll actually look at the car and they'll times it by that business percentage. Now, when you actually drive someone else's car like that for a limited period of time, you could still provide that to your CPA. The question becomes is that the IRS is going to say, well, is that your car that you're using specifically for business purposes, and would they allow that? I believe your CPA probably would just throw that into the total mileage expense that you incurred for the year. But if the IRS were to audit you, they may disallow that. So just
Does not have time for people like us. We just like very low out there.
yes. Yeah, that's right. Yeah.
About like your expenses when you're buying your outfits, how much of it is deductible, and your hair and your nail and everything?
So if you can, here's the question. You have to show it's an ordinary and necessary expense towards your trailer business, right? So I agree. I'm not arguing against it. I'm just saying you don't have to prove that to me.
I'm like, yeah, I can be the laughing stock.
Yeah, so it's like you don't have to prove it to me. It's just like once you get the IRS auditor who hasn't done her own hair for a year and doesn't dress up, then you have to prove it to her. So it's not me. Yeah. What's that? Travel? Oh yeah. So just keep all your expenses for travel as well. So again,
Because if I'm like going back and forth, I'm just like going back and forth to see if it's a viable property. I mean,
yes. So that also qualifies as well. I mean, that's part of your business in scoping out properties. The only thing for that is you cannot count commuting miles to and from your principal office. That's the only thing you can't do. If you're going to go from the office to a site and then come back, but oh yeah, that too. Yeah, flying also qualifies as well.
But
So
what were you saying?
oh, so like for total mileage, so the only things the IRS does not allow, if you're commuting from your home to the office, those are not technically business miles, right? Whereas if you're commuting from the office to like a property site or to go to a client meeting, those do qualify. So that's the distinction there as well.
Oh.
Yeah.
One more question.
Yes.
Is there a limit on client gifts?
Yeah, so typically it's $25 per person per year. Yeah. 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 Oh, yes. Yeah. Oh, so dining, that's a little different. It's not technically a business gift. So if you're giving somebody a gift card or a present, typically you can only deduct $25 per person. If you're going out to dinner with somebody or any sort of meal, you can deduct it right now for 2022, you're allowed to deduct up to 100%. But from a go forward basis, it's going to be 50% and beyond. So yes.
Sorry.
Yes.
So if you have a farm of 2,000 people, right?
Yes.
$25 per person. Can I do that?
Yeah, I mean, technically, but you got to have a business purpose for each gift. The IRS, I'm not kidding you. They're going to make you write down a business purpose if you get audited for each and every single one. And then, yeah. Yeah, exactly. Yeah. So, and then, so sorry, that she's been her hand up for quite a while. I can see her shaking. So, yeah. I know. Yep. Yeah, that's all deductible. So like without limitation. Yeah.
Statements is good enough, or do you really?
Yeah, actually, no. So credit card statements are generally sufficient. So, I mean, some of them are really obvious, right? So like when you're paying for your MLS fees, if an auditor were to see that, they're not gonna be like, what's the business purpose of this, right? If it's on your business credit card, you're obviously a real estate agent. They're not gonna question that. It's when they see like that $5 charge for McDonald's at like 2 or 3 a.m. and you're coming back from going out somewhere at nighttime. They'll be like, did you really go out to dinner with somebody for a business meal? Or like, what's the deal here? So, yeah, yeah. Yeah, so I mean, for just your own record keeping purposes and potentially giving to your CPA, it's easier to have your own business card as well, so you clearly distinguish it. But I mean, just because you consolidate your expenses on a single card doesn't mean the IRS is going to disallow those things that are clearly like related to your business. So prove it, yeah. And usually, here's what I will say. If you have a CPA, they're typically always going to want it on a separate card, because if they're doing bookkeeping for you, it's way easier for them to do it. And also it probably just lowers your overall tax prep cost as well. So. Yep.
I think I'm not a savvy business. I have too many expenses.
Yeah, just write it all off and then see if the IRS says no, you know? So, oh, yes, 2 more. Yeah, go ahead. Yep.
Oh, so what's the best deduction as a real?
So the best deductions, well, all right, so here's what I would say. Anything that is arguably related to your business as being a realtor, and if you have a separate credit card for, business purposes, I would say try to write it off, right? A lot of times what I do with my clients, because,
What did you say, write it up?
yeah, write it up, so expense it. So, or put it on your business credit card, right?
So if I have a business card, do I have to write it up, everything, or I can just like put it on business?
Yeah, so I would say put it on the business card. What I do with my clients, because a lot of times they're in similar situations, I tell them if this is even related or arguably related to your business, put it on there, right? And then when I actually prepare the returns, I look at all the charges, right? And I ask about certain ones that I could tell, like if I were an auditor, I'd be like, okay, what is the purpose of this, right? And can we actually take this as a deduction on your return as well? So for you, I mean, obviously it's going to be like your travel miles, your gas, like going from like meeting to meeting, looking at different properties, any sort of advertising that you do, if you're taking clients out to lunch, obviously if you're giving out business gifts, not only to your clients, but to maybe other offices that you're presenting in, dues and subscriptions for MLS fees, maybe you're doing education, maybe any sorts of like travel expenses or expenses you incur to go to like certain types of like meetings or networking events or just like presentations and things like that. Office supplies, that's right. Your computer, any sort of equipment you use in the business, right? Like your telephone as well. Certain sorts of, and another good one that a lot of people don't realize is like your home office expense. So if you're 1099, you may have an office here with Coldwell Banker, but you probably also have an office at home. So there is a way to write off certain sorts of home office expenses. And the way you do it is you look at the square footage of your home office versus the total square footage of your house. And then you times that by your utility. So that'd be internet, right? That could be electricity, gas, things like that. And then as long as well with like your rent or your mortgage interest as well, right? And then you can actually write that off against your trade or business too. So that's another big one a lot of people don't realize. But you have to go through and pull reconciliation of all those expenses and give it to your CPA so they can calculate that as well. Beyond that, I don't know if any other easy ones that come to the top of my head, but.
So when you're talking about lunches and all that, when you go to lunch with other realtors and stuff, is that considered networking and part of business too?
Oh, yeah. So you just have to be able to say, we talked about this one thing for business, right? Like this one strategy for advertising. So that's it. Anyone? Yes.
Can you go over the taxes? About something else, like Rich has gone over this many times, but is it different in 2023?
Yeah, so no, it's actually the same, right? So typically when you sell a parcel, it could be personal property, it could be like a rental property. Typically, the way that you're actually going to calculate the tax is right. So it's going to be the sales price less the amount that was originally paid for the house, plus and less additional improvements or capital improvements you made to it. And then if it's a rental property, you've also probably taken depreciation on it as well. So that's like that additional expense we're talking about. You actually have to recapture that as an additional capital gain at 25%, right? So assuming that you've held the property for more than a single year, that gain you calculated is going to be subject to a tax rate between 0 and 20%. And it's typically 0. And it just depends, I'm sorry, it's typically 20. And it just depends on your total taxable income for the year. So, and then, so that's typically, or the most general way that you can calculate taxable gain for the sale of real estate. Now, if it's a principal residence, right, I think a lot of people know this. If you've lived in the house for 2 out of the previous 5 years as your principal residence, you can exclude up to $500,000 of that capital gain, right? That's only if you're married. But if you're single, it's 250. And then for rental properties, you're not entitled to that sort of exclusion. So again, that's only for a principal residence.
Okay, so if it's a principal residence, then it's how much federal and how much state?
Oh, so for federal, so it's the same for both federal and state, but so it's 500,000 if you're married.
No, but the tax rate.
Oh, so for federal, it's going to range anywhere from 0 to 20%. And that's just going to depend upon your overall income level, right? In addition to the gain you incurred. And then for California, there is no preferential capital gains rates. They tax everything, whether it's a capital gain or ordinary income, all at ordinary income rates. So the highest rate in California is 13.1%, but typically that's for people who have income over $1 million.
So the tax rates are for capital gains is based upon your taxable income, but you would add the capital gain in to
Correct.
determine what your adjusted gross income is.
Correct.
To determine what the capital gains rates would be.
Correct.
So that's gonna be,
So most people, when they sell real estate, fall into 20% rates because it puts you in a high enough bracket.
it increases your tax bracket, right?
Because-
Calculating. the capital.
So you only fall in the 15% if your income levels, including the capital gains, between $49,000 and I believe it's $500,000.
Right on there.
Yeah, so it's like if you sell a house in California, you know,
So if your income's between 50,000, 40,000 and 450,000.
Yeah.
The federal capital gains tax rate is 15%.
Yeah.
If you're over 450,000, and that's including the gain from the sale of your primary residence, then you'll be in a 20% federal tax bracket.
50,
Could be 15, correct. Could be.
plus the 13, always the 13.
No. So that's just the top marginal tax bracket in California. So that California's tax brackets range anywhere from 0 to 13.1%.
Oh,
So if you have over $1 million in income in California, then you have a 13.1%. But typically, most people fall anywhere from like the 5 to 9% range in California.
So from those entities that you discussed, for realtors, because they're their own.
Yeah.
Their own business, right? Do you recommend any of those for realtors, to I guess,
Operate through.
operate as one of those entities? And if so, like, what's the income level that you recommend? If you make it up
Yeah.
on this, you know?
Good question. So actually, if you're going to do this, so it would be an LLC because it's the easiest and most flexible to set up, right? And from a management perspective, the owners are the managers just by default. And then you would want to treat it as an S corporation because you still have that same flow through income that's not subject to the self-employment tax. Now, I would only recommend that because when you form an S corporation, right, and so you form an LLC, tax as an S corp, you have additional costs every single year. So you have the $800 minimum franchise tax fee. And then you also have to pay a CPA for an additional return, right? Because you have to file an S corp return each year. So typically when the tax savings outmatch the additional annual cost and burden, when you make about $45,000, it just depends on your personal situation, but it's anywhere from about $40,000 to $45,000 in net income. So if you're making that, then it makes sense to actually start operating your business through that entity, right? So that's a very good question, though. Yeah.
One question, last question, okay.
I had one more in the back too.
All right,
Yeah.
I'm sorry, go ahead.
Okay. Good. She said you could go.
Oh, well, thank you. That's very nice of you. A question that comes up often has to do with estate planning. Parents, grandparents want to give their property to their dependents or their children.
Yep.
Can you just address the implications of that and what the best tax planning is for that?
Best tax planning is to die.
To die.
So unfortunately, so if you're going to give it away, actually,
if people are planning and giving away things, now is kind of a one-time opportunity to do so through the end of 2025. So what happens is when you give away property just during life, you actually create this thing called a gift, right? And you could typically give gifts to each person up to $17,000 per person per year before you actually incur a taxable gift, right? Once you go over that amount, then you actually have to file a gift tax return. What happens is that if you don't, so let me back up a little bit, because there's also this thing called the lifetime estate tax exclusion. So if everybody, so if a person passes away and their estate is worth less than about $12 million, they don't pay the death tax or the estate tax, which is 40%. Any value of an estate over that value is subject to a 40% tax. So what happens is that each year you get an annual gift, or each year you get an annual gift tax exclusion, $17,000 per person, $34,000 per married couple. If you go over that value, you start to eat into that $12 million estate tax exclusion, right? So, and for a married couple, that's 24 million. So that's quite a bit. So assuming that you make enough of interlife gifts that go over that full lifetime estate tax exclusion, you start to pay the 40% tax on those interlife gifts. Now, the reason why I say there's a one-time opportunity is because that estate tax exclusion on a per person basis is going to be cut in half to $6 million at the end of 2025. The current Congress, and they actually proposed this as part of the Build Better Back Act, was to reduce that from 6 million down to 3, 1, or 0. So that means essentially any gifts, if that does go through, would be subject to a 40% tax. So and the IRS has already come out to say that that drop from the 12 million to 6 million per person is not going to affect the 6 million you're entitled to at the end of 2025. So there's a lot of people with large estates or with assets in their estate they think they're going to appreciate quite a bit that are gifting them right now because it's not going to be taxable. They'll have to file a gift tax return because they'll use that inflated estate tax exclusion and then keep whatever they still have for that $6 million at the end of 2025. But to your question is, if you do that, then you're not only going to have to file a gift tax return, but there's also property tax consequences. So you guys know from Prop 19, like you used to be able to gift other property, right? And you used to have $1 million of value exclusion before you had a reassessment. Well, as part of effective February 2021, they got rid of that. So if you gift away any property besides your primary residence, it's going to be subject to a reassessment, which is going to be pretty high, especially with the increased values, especially if grandma and grandpa are giving that away. So the only way to avoid the estate tax, right? I guess there's one more thing I want to talk about too. So if you give something away during your life, you take the same tax basis as that person that owned it, right?
Yeah.
So if grandma bought that house in the 50s for $50,000, but now it's worth $1 million, and she gave it to me and I sold it, I have to pay tax on $950,000. Whereas if she passed away and left it to me, I take a tax basis equal to the fair market value at the time of her passing. So then I could sell it for no gain, right? So there's a lot of negative consequences that come with interlife gifting, but there is also some planning opportunities for the right people to give away things during their life right now. Yes.
So if someone gave you 17 or 17,000, let's assume 20,000. So not Donnie, just somebody gave you a check. So he has to pay tax on it or no?
No, so likely they would not have to pay tax on that. Yeah.
I'm
But-
gonna ask one. Someone-
Yeah.
That's it.
No, it's okay. So,
The gift. I don't know if it's later. Lot of time we do the wedding things, and my clients tend to get gifts from their family. Is that part of this whole thing?
yeah, so that could be part of it, because you can give, a married couple can give up to $34,000 per person without running into any of those negative consequences, right? So a lot of estate planning, if you think they're going to have an estate over that 12 million per person or 24, which is going to be cut in half in a few years, people will start gifting away that amount to their kids, family members, so that when they pass away, that, you know, their estate potentially isn't subject to that 40% tax. So people will do that in the form of just giving cash. Actually, one of the better ways to do is if you form an entity, right, and you give away little pieces of that entity each year to your kids as well, right? So there's a lot of ways to go about it, but yes, that's probably what they're.
When you say gift funds coming for the down payment, are those taxable?
So yes, technically you have to file a gift tax return for it. Now, it's not going to be subject to tax because most people haven't utilized their full estate tax exclusion, right? So if you go over the $34,000 per person per year, then you start to eat in that $12 million lifetime estate tax exclusion. And right now it's 24 million for a married couple. So most people won't give away in their life to get over that, right? So because you just start to eat at that, and that reduces the amount of estate tax exclusion you have when you die. So like if I were to give my kid like $1 million, so I'd have to file a gift tax return saying, okay, here's the $1 million, but I don't have to pay tax on that because I have $12 million of estate tax exclusion. And then when I die, I'd only have 11 left, right? Just to put in the terms of an example. So
Even between husband and wife, then if one transfers that can.
yes. So between husband and wife, there is no, it's not taxable whatsoever. That is an exemption. So.
And then John Barrett has a question online.
Yep.
He says if his office is at home and he has pool and landscaping expenses.
Yeah, you can. So, yeah, you can. So,
Yes, Josh?
yes.
What was the question?
He said if his office is at home and he has pool and landscaping expenses, can he add those to the home office deduction? So any expenses to maintain the property technically qualify for the home office deduction. But again, they're just prorated against total square footage of your office over the total square footage of your home. So they're significantly reduced, right? So. All right.
Not the question.
No, thank you all.
Yeah, thank you guys. Yeah, good to see everybody. So, yeah. Yes.
Yeah. You want that? Next question.
No, so the only time you can use that as a deduction is if they reported.
No.
So. Yeah, so you'd have to give them like a 1099 as well, but I wanted to do that, so. So unfortunately not, because most of the time you're giving a gift. It depends upon the situation. So sometimes it would make sense, like if you have family members who are like low tax brackets, right? And then you want to take a deduction, if you give to them, you'll have to pay. All right, but technically you would still pay on their tax.
Bye, everybody. Thanks for coming today. I appreciate it.